If you've ever bought VIX calls on a Friday, only to see them open at a 50% haircut on Monday, go ahead and hit that like and subscribe button. Folks, thanks for joining us for another Friday webinar. I am pleased to announce that I'm here with our special guest, Chris from Spartan Trading. Happy Friday, Chris. How you doing?
Good, good. Thanks for having us. Thanks for having me, I should say.
My pleasure. Thanks for joining us. So I think the first thing that we should do here is go ahead and tell us a little bit about yourself and how you got into trading, and then let's dive into some of the content of this webinar here. Couple administrative notes right as we start. There will be a recording available of this later this evening. It'll be posted on the Benzinga Pro help site. It will also go out in the email to everyone that registered, and I will also be sharing it with Chris. So if you can't make the whole thing, don't worry. There will be a free replay for you to see later on. So Chris, take it away.
Sure. Do you want me to just throw up my screen as well?
Yeah, you can go ahead and share your screen. I think you've got a slide about your history, right? And how you got into the market, just who you are.
Yeah, absolutely. So guys,
Let's do it.
My name's Chris, by the way. Spartan, everyone calls me that. I started trading when I was basically first year university. I went to university. I basically took finance, and within university, I got introduced to trading through one of my professors. He actually was the head of TD Securities for Canada. That's where I'm located at the time, or was retired from that job. And basically, we used to talk one-on-one, and I started trading from that. Before that, I also had, basically a big interest in trading just from when I was young. I thought it was a cool concept to be able to, make money by looking at charts or patterns and figuring out things that maybe other people did not see. Trying to find an edge where other people could not see, and it always is dependent upon how much effort you put in. So that obviously to me was fairly interesting, and that's kind of why I got into it. He pushed me for sure more into it. And then as I did it on my own, I did a lot of trial and error. I was reading things on Google and whatever else to figure out what's working, what doesn't. I did, like I said, a lot of back testing myself, where I would actually test what I'm doing, record it on Excel, try to get 100 to 200 data points. And based off of that, I could figure out the probability of something working. This would always be over the course of a fair amount of time, so that I could see that it works in not just the market currently, but in different markets. From there, I progressed and kind of to the trader I am today. So about 9 years professional trading. I spend probably about 12. It's probably more hours in front of the screen than this, but 12 plus hours in front of the screen for sure every single weekday. On the weekends, I do a lot of charting on Saturdays and Sundays, just because my group keeps me busy, and I do a newsletter and things like that for them. But technical trading expert, that's what my niche is. That's what I'm good at. I got aligned with a lot of different traders over my career. The two which I did start Spartan Trading with were Beth and South Beach, which is Steve. These guys, or this gal and girl, both institutional traders. Between them both, they have 83 years of experience. So they kind of, when we first met, took me underneath their wing. They both told me I was something special in regards to how I would trade from a technical standpoint, and my basically skills at recognizing certain things that other people they didn't see would as quickly recognize. So that was a great compliment, and we all complement each other in that, Beth is a very well-rounded commodities and options trader. South Beach Steve was a big macro trader. So learned a lot from those individuals. So, basically that's my background. That's kind of who I am. This is the team that I'm working with right now.
That's awesome. I mean, that's a great compliment to get from a group of people that have had years of experience. That's absolutely tremendous. All right, so let's dive right in then. I know you wanted to talk about actually using the news to trade and how you can pick the right news. So how do you go about doing that?
So one of the things I wanted to talk about today, and I'm a huge advocate, and I think everyone should be a huge advocate on risk reward, basically understanding what that ratio means. And if you understand what that ratio means, you need to be able to bring it into every single position or opportunity that you see. So when we look at different opportunities during the trading day, a certain setup, it's not just about the setup, it's about the actual risk reward behind it. There always needs to be two things that align before you take a trade. So what I want to do today was actually talk about, not just technical setups, but setups in regards to seeing something news related. So when I'm using that Benzinga wire, which I do use every single day, and this is what mine looks like. This is how it's set up. I'm looking at both options sweeps basically and options alerts, and I'm looking at also news alerts. And I'm going to go through an example that I actually traded today, and I actually just did one after hours on NSCO, just a little bit of a scalp on the news that came out. We'll talk about basically what news I actually look at. There's a lot of different things that you can you're going to see obviously during the trading day. There's certain things that are always going to be actionable, so that's what I want to talk about today as well at the end. Anywho, let's just start off with kind of the first concept, which is going to be discussing risk reward. Now, risk reward is something that needs to be part of your system, whatever you're doing, in order to be consistent from a long, or in order to be consistent over long periods of time. You need to have risk reward, that ratio skewed in your favor. And mathematically, it's impossible to be profitable if that ratio is not skewed in your favor over long periods of time. And I'm going to show you a visual representation of that in just a second. Like I said before, there's always two things that need to be constant when you do take a trade. It's the setup, which it could be news, technical, alert driven, and then the risk reward, which the risk reward, like I said, part of your criteria. This should be part of your rules, and this is going to be key to profitability. So let's talk about...
I got a real quick question before we move on there. Does your risk reward calculation, does that ever change, or is that pretty much constant every single day, no matter what trade you take?
So
I get that question all the time. How do I evaluate my risk reward? Should I change it based on what I'm trading?
Sure. So when we talk about risk reward, we're talking about what you're comfortable risking. Everyone's going to have a different risk amount per trade, depending upon their account size and depending upon how experienced they are as a trader. As you get more experienced, as your account grows, your tolerance for risk will increase. So your risk reward will change over the course of time as your account grows and as you become a more seasoned trader. So yes, your risk reward should change over the course of time. It doesn't have to, but it should as you progress, and experience, or as your experience progresses, and you grow your account. So we'll dive into that a little bit more. I'm actually going to talk about that specifically when we look at how to set up your risk reward. But yeah, absolutely, it should change. So let's talk about what this ratio is, guys. The ratio, pretty simple. I mean, it's what you're willing to risk and what you're trying to make per trade. We always say that you want your risk reward, and I always say you want a minimum of 3-to-1. And this just ensures that you can literally be wrong a larger percent of the you can be wrong literally less than you can be wrong less than or more than 50% of the time, I should say, and actually still make money. We'll talk about that, and I'll show you the math behind that in a second. But that's why it's such a powerful concept. You don't always need to be right, and you can be profitable.
And that's really important because I've never met a trader that's always right, even the best ones. So it's really important that you can actually set up a system like that to maintain profitability. It's a really good point.
Yeah, absolutely. I mean, no one's going to be right all the time. Right. I'm certainly not. And when you're wrong, it just needs to be controlled.
Right.
Every single time. And obviously, the more that you can skew that risk reward, the more exponential those gains can become and the more power you can have behind when you are right. I'll talk a little bit about the scaling in concept. I mean, that's kind of a discussion for a different time. That can really skew your risk reward. We'll cover it because it is covered in the little spreadsheet I want to show you, but it's something to keep in mind as well. So risk reward ratio, obviously super important for profitability. It ensures you don't need to be right all the time. When you're wrong, it's controlled. And also from a mental standpoint, it's super important. If you're very stressed out all the time, you're having trouble sleeping if you have overnight positions on, most likely your risk is out of whack. If you can lower that risk amount to a place where you're very comfortable, a place where you don't, quote unquote, care about losing the amount per trade, then you'll trade a lot better. You'll trade without emotion. I always ask traders, and this is a very good example to figure out how well risk reward works. When you have your best days trading, it's most likely a day you woke up and were in something and you're up quite a bit of money in it, and then that day you're very picky. That day you're very probably not emotional at all because you have a nice amount of cushion for the day, and you're going to be trading with less emotion in general going forward. So
absolutely correct in my example. That's phenomenal that you said that. My best day ever was the day that Kraft merged with Heinz and I had Kraft options.
Well,
And
there you go.
it was exactly like you said. I was more picky. I was able to put the emotion aside. It was the best trading day that I've had in my career. So,
Yeah,
good point.
I mean, it's something to come into the market when you're playing. When you're playing offense, it's easy to trade. When you're playing defense, it's hard to trade because you're always trying to come back and you're doing riskier things to come back, revenge trading, all that stuff.
You nailed it.
Yeah. So, anyways, let's talk about that ratio. Let's actually look at the spreadsheet that I want to show you guys, kind of a visual representation of how risk reward works, etc. Now, what this is, and I created this years ago. Actually created it for myself, and then I started to show people because there's a lot of different explanations about risk reward out there. And I think, people do an okay job of explaining it, but to see it visually is a lot more powerful. What this is this a full year calculation of, 5 trades per day at a random probability of success of these trades working. The only variable is risk reward. That's the only thing that we can adjust. So
can you zoom in on this a little bit?
Yeah, I was just going to zoom into the top here.
And so real quick before we start, we've got 2 questions from 2 different people here. Just curious, why no live face view for Spartan, and how did you come up with the name Spartan? And another question here about the no face view. So I think that you said that you had your camera is on a different computer. This is actually your trading computer.
Yeah, this is my trading computer. So what you guys are hooked up to right now is I have 8 screens. This is my trading computer. I don't have a webcam hooked up to it. It's a desktop. It's not a laptop or anything like that. So that's why that. And then the name Spartan, I'm Greek heritage, and then also the work ethic of, the warriors, the Spartans is, second to none. So I kind of have and encase that work ethic and what I'm doing in my life. So there is a little bit of synergy there, but it's mainly because of my Greek heritage. That's why.
Gotcha. Awesome.
So yeah, not too much behind that, but yeah. Anyways, just talking about a little bit more about risk reward, guys. So like I said, this spreadsheet is a visual representation of 5 trades per day, full year's worth of trading. The only thing that we can control, the only variable is risk. Everything is random probability that these trades would work. So what I want you to focus on is up here, 2 areas. Risk reward ratio, so the actual ratio that we're going to be looking at. And then below that, I'm going to try and zoom out a little bit so we can see this at the same time, is the yearly profit. So when we have a risk reward ratio of 3 to 1, you can obviously see that the profitability is quite high. When we have a risk reward ratio, and let's just make this a little bit lower. Let's go, I'm going to risk $100 to make $100 per trade. One of the first things I do when I talk to traders that are new to trading or that come into the room, whatever, the first thing that I always say is let's set up a risk reward profile. And the reason why is most people don't think about it or don't think about skewing that ratio too much in their favor. They'll, I want to risk $100 to make $100. But when we do this and we repeat this over the course of time with a risk reward ratio at 1 to 1, you can see that the yearly profitability is going to be, fairly low. It should be actually negative. Most people are not paying, commission anymore, but if you're trading options, there's going to be some commission behind that, and you will certainly be negative. So we can see that 1 to 1 risk reward ratio, obviously not great. The best thing and the most powerful thing about risk reward is once we start skewing it just a little bit. So now I'm risking 100 to make 110. You'll see that the yearly profit is always going to be consistently up. The more you skew this in your favor, let's just go to 2 to 1, the more exponential it becomes. As we skew it more, like we say, we want a 3 to 1 minimum. Whoops. This just ensures that you can literally write only 34% of the time and still be profitable. So there's a lot of power behind that. Not needing to be right all the time is one of the biggest things that traders misconstrue. People, whenever they ask, especially about performance, they usually ask about what's your hit rate? What's your success rate per trade? Not what your risk reward ratio is. And that should be what they should be asking, because this is where profitability is derived from. You can be right 99% of the time, and if you have one trade that, the risk is not controlled, it can blow up your account. Yep. I'm sure you guys have been on Twitter, you've probably saw or have seen horror stories where, maybe a short seller doesn't have a stop, and they get into a situation like, GLSI the other day where it went up to $144 from 12 or 16 and they got blown out. Or vice versa, a situation where something from, I don't know if you guys remember, was it Lucky Brand's coffee was at $32 or whatever. Fraud report came out on it. It dropped down to like $2. Same thing on the long side can happen, right? If you don't have stops, your risk's not controlled. Doesn't matter how right you are. One trade, it's all it takes to take you out. So
That's right.
Such a big importance on actually skewing this ratio. Now, okay, we understand how the ratio works. We understand why it's important. Let's actually talk about how to apply this. So it's different on the option side. It's different on the equity side. And in that, the only difference on the option side is now we got to look at delta to figure out basically where our profit target area potentially is. And we'll talk about how to figure that out in just a second. Let's start with the equity first. So when we talk about what risk reward makes sense for you in your account, you're going to have a certain threshold of risk that you feel comfortable with. There's also a certain threshold that makes sense from a percentage standpoint to risk per trade. Now, smaller accounts don't have the luxury of risking smaller percentages per trade and being able to make a significant or decent amount per trade. The larger accounts do. As your account gets bigger and bigger and bigger, the risk per trade per percentage of that trade should decrease. It doesn't need to, but it should. So let's talk about just a average, $25,000 account, for instance. So $25,000 account, risk per trade should probably be around 1% or less. So let's just make that risk $250. Reward $750, 3-to-1 ratio minimum. So the account would be, like I said, 25,000 based off of this. And let me just quickly explain this little spreadsheet here.
Okay.
What we have is the price of an equity, $1, $5, $10, $15, $20, $45, $55, etc. Beside that, we have what your max capital per position would look like. So whatever your max size per trade would look like. Beside that, we have a scale size, which whenever I trade, I like to scale into positions. And the whole rationale behind that is if I take a trade with full size and it doesn't work right out the gate, I'm going to get stopped out fairly quick. My stop's going to be a lot tighter to my average.
Yep.
So I don't have a lot of breathing room. If I take a position with a quarter size, I can give it a lot more room so that, it can breathe, it can work. And then as it starts to work, I can add into the position. What do we know about trades that trend? Trends tend to hold, I think it's like 70-80% probability or 70 to 80% of the time. If you can use the trend to your advantage to add into a position, then right away you're going to have a higher probability of success just in general.
Now, do you ever add to losers?
No, never.
That's one of my rules too.
Yeah, and we can talk about the math behind that as well, actually.
Great.
So, going back to this little spreadsheet here, stop on scale size, we can just ignore that for now. This is just where your stop would be based off of that scale size. So you're going to see that you're going to be able to give it a little bit more room. Scale size profit, ignore that one. Stop on full size is just where your stop would be on your full size to ensure that you're not going over a max $250 loss. And then profit target on full size is just where you would need to see upside to in order to meet your goal of $750. So let's quickly just kind of adjust some numbers here. And then we'll talk about, and we'll go through some examples of how you can actually do this, intraday or on the swing side, whatever you're doing from a trading standpoint. I think that should be fine. All right, so let's say, for instance, I'm looking at a stock, and let me just quickly just blow up or throw up a stock here. Let's talk about something from today, like HCAC, I should say. So HCAC. So, for instance, we'll talk about this from a technical point of view, and then we'll bring in news related when we talk about Benzinga a little bit later and how to use that with risk reward. But for the ease of this example, let's just talk about this name from a technical standpoint. So let's say that you wanted to trade HCAC and you wanted to take the position long and you wanted to apply risk reward. Now, the whole point of risk reward is making sure that the amount of upside, the opportunity that you're placing yourself within has the potential to make you your profit target. So in this case, let's call the stock $20 at the time when we're going to look at it. I need to see $1 of room to the upside in order for it to meet my goal of $750. So HCAC, and at the time, we'll talk about it on this downtrend break here, just real quick. So downtrend break at 1958. I need to see $1 of room to the upside in order to meet my goal of $750 given full size. And it technically would have room, I would say, until the high of the day, which is going to be around 2156. Now, we'll talk about another example as well. One of the things you need to be able to do in order to set up risk reward correctly is you need to be able to recognize how much room charts have to the upside or the downside. There's two ways that I do this. The first way I do it is intraday. I look at highs and lows, basically the high of the day, the low of the day. And I also look at the daily chart. The daily chart, what I look at is resistance levels or support levels that stand out visually to me. And I use these levels as target areas or where the stock has room to. So let's say the stock, for instance, broke 2157. The next resistance to the upside would be 2243. That would be the next resistance. So the stock would have room from 2157 to the 2243 level.
So when you're coming up with these levels, do you just eyeball them? Do you use things like moving averages, Fibonacci retracements, anything like that? Or is it just by eyeballing?
Yeah, so I use Fibs, I use EMAs. Just for the ease of this webinar, I took everything off my charts just because there's so much different stuff. We could go into Fibs for 2 hours. Or
except we could do an entire presentation on that alone.
Exactly. But for this demonstration, I just wanted to leave it blank. But anyways, so two ways that I do it. Intraday, which would be looking at the highs and the lows of that day to figure out what the range is and where the next resistance or support level is, and then using the daily. I usually default to the daily, but if I don't see anything on the daily chart, like there's not a lot of data on HCAC, then I'll defer to the intraday chart. So in this case, it broke the downtrend at 1961. It has room towards 2157. In this case, you got what from 1965. So you essentially have 2 points of room to the upside to hit your target. Now, it does, just because you see it has room towards 2157 does not mean you're going to go into that target. You're just making sure that you have the potential to get to that target. So if you have the potential to get to that target, then this trade meets your criteria in regards to your risk reward. So what's very important is to only place yourself in situations that meet your risk reward. And if you can do that over and over and over again, we can see that from the spreadsheet and from this demonstration that if you repeat that process, even at a random probability of success, you'll make money. So going back to this spreadsheet here, ensuring that it had $1 room to the upside on this downtrend break. So we have the setup, check, which is the downtrend break. The risk reward makes sense, check, you take the position. Now, I could, like I said, I would discuss scaling it if we had more time, but in this case, let's just say you went in full size right out the gate, which usually a no-no for me. Given 15,000 shares or $15,000 full size on a $20 stock, you're taking 750 shares, and you're obviously looking to make your 1 point of, to the upside. In this case, would have worked out nicely. You would have made your goal. You probably would have scaled some out at your goal and then, left some on, moved the stop up, etc. And as it broke the uptrend off the lows, then you would have got stopped out. So that's how it would work on the equity side. On the option side, because I know now there's a ton of options traders out there, especially newer ones. Yep. Super important to understand how risk reward works from that standpoint. Risk reward on the option side, a lot more important than the equity side because options are decaying assets. If it's an out of the money contract and if it's short dated, you have a very high probability of the contract going to zero, 66 to 70%. So when we look at option trades, we need to understand how much room we have on the underlying stock and what that translates to on the option side in regards to whether or not the contract has enough room to meet our goal from a risk reward perspective. So when we look at an options trade, same concept. Let's look at, obviously you're going to be using less capital to trade options, which is the nice thing about options.
Right.
You can increase the amount of leverage you have essentially. Let's just reduce the sizing down here, 500. Let's go.
And so this is dollar size, right? This is not the number of contracts.
Yeah, this is dollar size here per contract price. So a 50-cent contract, if you had $1,000 into a 50-cent contract, your max contracts would be 20.
Gotcha.
Scale size 5, which scale size to me, I always go by quarters or 1/8 actually. But so I usually start with a quarter. And then based off of that, the contract would need to move 38 cents of 38 cents to the upside in order for you to meet your goal of $750 if you had 20 contracts in it, which, makes sense. In regards to your stop on full size would be 13 cents away from your 50 cent average if you had 20 contracts. So I'll quickly just, I think this is actually okay. I think what I'll do is I'll actually reduce the size a little bit just to give these things a little bit more room. As we know, obviously, options are a lot more volatile than equity,
Indeed.
guys. So this is where scaling in is, really matters. But again, for this webinar and for ease, we're just not going to talk about scaling in today. Let's talk about a $1 contract. Actually, you know what we can do? Let's talk about a 25 cent contract today. So I got some examples from today we can actually talk about.
Excellent.
So LMT, by the way, on Fridays, we have something in the room that we call Lotto Fridays. It's when I play expiration contracts strictly the entire day. And the reason why I do that is because if you can find, and this is where the technicals really come in. If you can find an opportunity that is out of the money, that can get in the money, you can get significant percentage movement on contracts on expiration days. So this was one that we took, which was LMT 362.50 calls. I'm actually going to get rid of the linkage here just for a sec. There we go. So in this case, we took the setup on just a range break to the upside. Range break to the upside, it had room towards 364.22, which was the last day high. The contract at the time was, I think it was 22 cents. But anywho, we'll just call it 25 cents. Mm-hmm. Same sort of concept. The only thing that we must bring into account is based on the delta, how much room does this stock or how much room does this underlying option have room to the upside in order to meet my goals. A little bit more difficult on expiration days because obviously as the contract price approaches the delta, if it's close to being in the money, that delta is going to increase significantly. Then as it gets in the money, it's going to go to 1. A little bit more difficult, obviously, like I said, intraday, but it's the same sort of concept where we need to look at based off of the chart. And let's just say the delta was 10 cents at 361.50. Based on the chart, it had room towards 364.22. We know that it's going to go to 1 if it does get in the money. That we need 30 cents of room to the upside. And in this case, a 25 cent contract would make sense to take with full size because it had the amount of room in order to meet your goal. The biggest thing with the options is more so on the risk control side. You need to know what you're also going to be risking per trade. A lot of the times I find that, especially newer traders, they don't control risk on the options. They'll follow a sweep or they'll follow, news coming out. Premiums will spike. They'll chase it. They won't have a stop. They'll leave it on. Friday comes. Option expires at 0. This just ensures when you have a plan going into a trade that you have an exit plan as well. If something doesn't work, you need to get out, especially on the option side, because these contracts, if they're out of the money, will go to 0. And obviously, as you hold things, they will decay, day to day because of theta. And if you were buying on news or buying on some sort of volatility spike, the premium is also going to come in on that contract as well. So it's extremely imperative to understand what you're trying to make per position, and also where your stop is going to be.
Now, is there ever a situation where you actually eat the contract, where you let it go to 0?
Yeah, so Lotto Fridays is a day where I'll risk the entire amount that I'm putting into the contract. So if I'm risking, in this instance, $250 per trade, then I'm only buying $250 worth of the contract. I only do that on expiration days. And the reason why is there's so much volatility on expiration days that if you do have a stop on the contract, you're probably going to get stopped out. Let's look at an example. I mean, you can see one right here on LMT. If you had, a 13 cent stop on the contract or 14 cent, let's say you grabbed it at 50 cents, it doesn't take a lot for this thing to whip back 40, 50%.
Yeah.
And then bounce back like it did here. Whip down to 30 cents and then it bounced all the way back towards 84. It doesn't take much on expiration days. If I'm going to be doing that on a non-expiration day, I have to be doing it on a very cheap contract. And it's the same concept. I'm willing to put in what my risk amount is on that contract and nothing more. if I'm not going to be using a stop.
Gotcha.
The best way to be trading, normally is definitely going to be using a stop and trying to scale into positions, and then being able to scale out on the option side as well is super beneficial, because a lot of times, sorry?
Do you do mental stops, or do you actually set the stops with your broker?
Hard stops.
I say again?
Hard stops always on everything.
Okay, so you actually set them in the broker.
Correct.
Yeah, the reason that I ask that is because I've actually tried to do that on options and have those stops not be filled because the options moved too quickly. So I was just wondering what you thought about that.
Yeah, so always I think it's extremely hard to use mental stops on options.
Yeah.
Just because of the volatility and how fast these price moves, the computer is going to be able to execute it a lot faster than you. Don't use stop limit orders, use stop market orders. There can be slippage, sure, but you just got to ensure that your sizing is correct so that if slipping does occur, it's not going to be the end of the world. In terms of equity, also, I think it's a great idea to set hard stops. Most traders are going to be trading more than one thing. If you're staring at the chart, you're staring at one stock, and that's all you're trading, then yeah, you can try using mental stops and see if it works for you. But from my experience and from all the traders that I've spoken to over the years, definitely mental stops are not as beneficial as using hard stops. And the nice thing is too, you don't have to worry about it if you have a hard stop set. If you leave the computer, you're going to do something else. If you're swing trading, you don't always need to be paying attention to exactly what's going on. You can let them work and let the things work and not be nervous or emotional about it. Okay, so this is how the risk reward works. This is why it's important. This is how we actually can apply it to a situation. Now, let's quickly go back to the PowerPoint here. So one thing is, when you start trading, or when you start trading options or equity, whatever, this is something that you should have defined for yourself. Whether it's you're building yourself a spreadsheet on Excel, which I would definitely recommend doing, building yourself a spreadsheet or building yourself an Excel calculator so that you know exactly what to be doing on any sort of situation you put yourself within. Putting it in front of you while you trade, printing it out, whatever. It has to be part of your rules. In order to be consistent long-term, we know that risk reward needs to be skewed. It's one thing to set up risk reward, but to not apply it, it's not really going to matter. And it does take a lot of practice to apply it. One of the things you'll find is when you start to, use risk reward, you're going to be slow at applying it. So, if you're trying to trade in the morning and you're just starting to use risk reward, maybe it makes sense to paper trade until you get the hang of it. As you practice, you're going to get faster at it. It's going to become automatic to some extent. And, at that point, then, you can take more trades at a single time. Trade when there's more volatility or when things are moving quicker, a lot easier. So apply it, practice it, make it part of your rules, make it part of your criteria, and you should see an improvement on the bottom line. It's just mathematics at this point. Now, using this trade criteria with Benzinga. So we talked about the first thing and the second thing that make up a trade. It's always going to be a setup and risk reward. We talked about the risk reward aspect, which is, I would say, 80 to 90% of when we take a trade, what's the most important thing. And the next thing would be the setup, which is actually some sort of signal to take a trade. Now, I'm a technical trader, so a lot of these signals are going to be based off of technicals, flags, flag fails, range breaks, EMA crosses, whatever, etc. When we use Benzinga, there's a lot of different tools that we can look at. The two main tools that I like to use on Benzinga are so what I do is I set up the option sweeps. So if you go to Benzinga, you go to Benzinga signals, it's going to give you basically a whole bunch of notable sweeps that come through, as well as block trades. Obviously, you can see all these that happened after the after hours there. Mm-hmm. But these sweeps are a great tool to get you focused on a name that has a lot of money being bet on one side or the other. And we'll talk about an example from today on this as well. The other side of Benzinga that I like to use is just their Benzinga Wire, which gives you, notable news that's coming out. The nice thing that I've noticed that Benzinga started to do lately is they'll give you a little bit of explanation on some things as well. For instance, SLS was selling off this morning. They wrote, SLS is selling off. News came out, it's probably profit taking. So they give you little explanations as well if you're not certain. That can definitely help you.
And let me just throw something in there
Sure.
just as kind of like a quick plug. Anyone that is a Benzinga Pro user can actually work with the news desk. So if you need a little bit more clarity as to something that's going on, you can actually talk with the people that are working at the news desk, and that can be incredibly helpful for figuring out why something is doing what it's doing. And then also, you had mentioned the BZ Wire source there. That's actually an aggregated news source. It's not just our news, it's also Reuters, Dow Jones, Bloomberg, etc. So you can get a whole bunch of content through that one single source.
Yeah, and it's it's a fantastic tool to use, guys. There's no other wire like Benzinga Pro. I mean, you can go look if you want, but a lot of the other stuff is kind of clunky, and the way that this application is set up is very smooth, slick. I like it, and makes searching for things very quick too. So if you ever are curious of why something's moving or why something moved in the past or what's been going on with something, just search the ticker name. It will bring up everything that's happened to it, within the short to past future or past I should say, and you can pretty much go through the whole thing there and look. Anywho, going back to basically idea generation and process. So when we look at the wire, we're looking at, for myself, for the most part, I'm going to be looking at sweeps and news. One of the things I'm going to be doing is using the setup, or an alert in this case, from Benzinga, and coupling it with my risk reward. So let's talk about an example here. And I think a great one was this VVUS today, where this, I think it was what, VV, let's just see. There it is. I think it was, I closed all my my windows, but I'm going to open them up right now.
And I'm just answering questions for you. Was it Veru? V-E-R-U?
Yeah, it's Veru. VRU. I was just looking at what I traded today. Veru. I knew it was a V. Anywho, so Veru news came out today on the wire. Someone actually posted it before I even saw it from the Benzinga wire today in chat, which is great.
Charlie, our squawker, actually squawked this as well. So not only did it appear in the newsfeed, but it was also read aloud.
And that's the other thing too, guys. If you can't be watching the Newswire all the time, like myself, where I can't be, you do have Charlie from Benzinga, who actually just talks about notable news that comes out. So anywho, Veru news came out on this thing that there was a $17 price target on the stock, and based off of that, it's a $5 stock, fairly significant price target. What we know, low floats lately have been moving, so this is something that could potentially run into the close, especially on a Friday. One of the things that I did is I brought up the chart right away, and I was kind of late to it actually. I grabbed it at 619, so this came out, and I actually tweeted, Veru moving, it's got room to this area as well. Anywho, so the alert, the news came out on it about the price target upgrade. The first thing that I did is I brought up the daily chart and went to go see how much room it has. So based off of the risk reward, and let's look at the actual chart here. So this is let's say it's a $6 stock, right? Based off of the risk reward, I need to see 60 cents of room to the upside, risk 20 cents for full size to meet my goal. In this case, it was actually fairly similar. I was looking to make 50 cents to the upside. What I saw was at 620, I had room to 786, which was the most recent range resistance to the upside closest to the price. So that was where my target was. That's where it had room to. So based off of the wire, which was the signal to get me in, and based off of the risk reward, this was a good trade to take. It was a good opportunity. Ended up taking it at 619. I was a little bit late to it, but because the risk reward still made sense, it still made sense to take the trade. And obviously we saw it push up to 750. I sold most of it at 743, and then that was that. So real quick, if you're able to figure out risk reward based off of the news alert or news alerts that come out, you're going to be able to put yourself into opportunities and situations that make sense. Now, on the other hand of that, what you're going to see a lot of as well is you'll see news that comes out and you're going to see risk reward that maybe doesn't make sense. It doesn't have enough room to the upside or the downside for you to make what you're trying to make on the trade. And in that case, you would just pass. Now, there's a lot of different things that come out on the news. Tons. One of the things is we need to be able to kind of weed through what's actionable and what isn't. There's a lot of stuff that's going to be actionable. There's no question. But we need to understand what's always going to be actionable. Now, in different markets, there's going to be certain things that are more actionable than others. We talked about kind of how low floats have been running. So when you do see news on low floats, if that's kind of what's been running lately, they're more likely to run. When low floats are dead and news comes out on low floats, they're less likely to run. You kind of got to understand what's going on in regards to a bigger picture. But there are always certain things that will run in almost all types of markets. So when we talk about news from the wire, we need to understand what can always have an impact on the price. Now, one thing that I always look at, or one thing that I always try to look at in every single news piece that comes out is, does this change the amount of revenue the company is going to be making in the future, positive or negative? And the reason why that's important is stock price is a reflection of future value of a company. The future value of the company is going to change based on revenue changes, right? So if the news affects the revenue, then the future value of the company should change as a result. When we talk about revenue changes, we can talk about mergers, buyouts, which can change the whole actually structure of the company. One of the things that I always look for on revenue change is contracts. So if we see a contract that's large in regards to the market cap, then it will move the stock. If it's small in regards to the market cap, it won't move the stock. For instance, if it's if Amazon gets a contract for 500 million, what's that in regards to their market cap and in regards to what they make per year? It's nothing. It's not going to have an impact on the stock. Whereas if you look at a small stock that maybe has a market cap of 30 million and they just secured a contract for, let's say, 40 million, then yeah, that should have a significant impact and should move the price. So those are one of the things that we can look for. Losing contracts as well. Obviously, when earnings comes out, earnings season just passed. Again, this could be a full webinar talking about that. But when earnings comes out on a stock, and let's actually look at an example right now. Let's see here. And this is, again, why I love Benzinga, because when you want to see what's going on the earnings side, they lay it out really nice. So earnings for Lulu came out basically yesterday. One of the things that I look at is not just what they're reporting for this earnings cycle, basically what they're reporting for the future of Lulu, looking for the next quarter or the next year. So earnings, earnings, we can use the tool from Benzinga to figure out how much more money these companies are going to be making in the future by looking at essentially the guidance. So if a company guides up or guides down, that should have an impact on the company going forward from a price standpoint. So a lot of the times when you see earnings guidance that is lowered, you're going to see multiple, most likely selling pressure on the stock. If you're going to see earnings guidance that is good, you're going to see most likely buying pressure on the stock. The further out the guidance is where you want to be looking, not at the close stuff. So if there's 2021 guidance versus next quarter, 2021 guidance is going to hold more weight than just next quarter. In this case, Lulu pulled back based off of their earnings. They also were bought up into earnings as well. But, we can see how that can have an impact on it. So revenue changes, obviously important. And then notable catalysts for biotech, which I'm sure there's a lot of guys who trade biotech, guys and gals that trade biotech here. But obviously phase 1, 2, 3 data will have an impact on the stock. One thing to recognize is when we look at biotechs, you need to look at what the overall runway is of what they're developing. So if there's if you look at something like Pfizer, which has how many drugs in their pipeline, hundreds of drugs in their pipeline, if one thing fails, it's not a big deal. They have so many more things in their pipeline. But if you're looking at a smaller cap bio stock, and they only have one or two things in their pipeline, and if they're both related and they have bad data on the pipeline or bad data on a phase 1, 2, or 3, that's going to be fairly negative for the stock because they don't have anything to fall back on.
Right.
So that's something to consider there. And then obviously PDFA, NDA, fast tracks, etc., other things that are notable on biotech stocks. I think it's worth emphasizing again, the less things that they have in their pipeline, the more of an impact these news events will have on the stock price. Because it's going to dictate whether or not, they're closer to, approval and then making money, or they're further back and their burn rate could possibly increase and, they have no way of making money besides doing offerings to stay afloat. So other notable catalysts, obviously fraud. So you see fraud or Fed probes on stocks, big negative, can cause them to sell off. Whenever I see that, first thing I do obviously is, again, bring up the daily chart, see where it has room to. In this case, it would be to the downside. And based off of the risk reward, you can decide whether or not it makes sense to take the trade. Short seller notes. We've seen a lot of these come out lately. Citron on LA. What was it? Laser.
LAZR, yeah.
Yeah. On, I don't know, 3 days ago. It was at $45 at the time.
And don't forget, didn't Citron come out with a positive note on JMIA?
Yeah, they did when it was at $16, I think.
Yep. And what's it at now?
336.
Yep.
Yeah. So these guys came out, obviously, negative report on Laser. Stock had a whipsaw reaction based off of it, then eventually, sold off the rest of the day. Now, whether that was, due to them or due to the actual price action of a lot of these EV type related names that day is, something up for discussion. But it is noting that short seller reports will move stocks, and they have been lately. Another one that's very notable is the short report on YY that came out. I think it was, I don't know, a couple weeks ago. This one really moved the stock.
It sure did.
Yeah, so this is one where you would for sure, and I shorted this one myself. You bring up the daily chart, you can see obviously breaks the range here. Where's the next support there, which is right here. Next support on the downside after that, so on and so forth, to figure out whether or not that setup has the right risk reward for you to actually make what you're trying to make. And if it does, go for it, take the trade. If it doesn't, then you just move on. There's going to be new news coming out all the time. There's going to be new setups presenting themselves all the time. Not the end of the world if you miss something and if it didn't make sense, it doesn't make sense. And then obviously big analyst upgrades, top tier. Two ways to look at analyst upgrades is if it's a huge price target that's really far away from the stock, it may have an impact. These are most impactful on these small stocks, especially if it comes from a top tier analyst. If it's a bigger cap company and it's kind of a nobody firm that's giving a far away price target, they're probably just doing it so that you read their research. I would ignore that. But if it comes from from top tier, Goldman Sachs, Morgan Stanley, Citibank, Nomura, etc., those types of names that names that move stocks, then obviously it's going to be significant. So just wanted to give you guys a little bit of useful information in regards to what I look at when I look at news, because it's important to understand news that can always have an impact on price, because this is going to be the stuff that you're going to be able to quickly then look at the risk reward. If it makes sense, then you make a decision to do something on that. So, that's essentially what I wanted to discuss with you guys today. I didn't want to take up too much of your time, but I want to talk about, two fairly big concepts and how you can basically bring that risk reward concept into whether you're playing news, alerts, or technicals, because it is an extremely important concept to apply to trading. If you're having problems with profitability, actually look at what your risk reward ratio is. If it's less than 1, then you know your issue. It's risk reward related. There's going to be certain ways that you can improve that. There's always two sides of risk reward. The first side is going to be, the discipline in regards to actually stopping yourself out when you should be stopped out, making yourself your size correctly so that when you do take a loss, it is at your max risk amount, not larger than that. And the other side is going to be conviction. If you're trying to make $750 per trade, the opportunity has enough room to get to that point, and you see that the trend's still holding in your direction, don't take off money just because you see that the trade's green. Let it work. If you can't let it work, try to moving up your stops or throwing a trailing stop on it. It is hard. Some people have usually issues either on the risk reward side or on the risk side, controlling being disciplined, or on the conviction side. One of the best things you can do if you're having issues on the conviction side is remove your P&L, focus on the chart, and it should help you out quite a bit. So that's essentially what I wanted to talk to you guys about today.
I do want to run through a couple of questions, if that's all right.
Absolutely.
So the first thing is, we got a question here from Daniel that said, where does one find a top tier analyst? How do you know if one is better than the other? Now, you touched on some that like Morgan Stanley, Goldman Sachs, Citigroup, Nomura. So is there any hard and fast rule, or is there any type of tip that you can give to our viewers on finding ones that are notable or might have more of an impact on the actual stock price?
Yeah. Basically, one of the things that you can do is you can actually just record which analysts are moving stocks. So make a little note when you see an analyst talk about something and the stock moves, just make a note of it. You're going to see other analysts that have no impact on the stocks. There's certain analysts at certain firms as well that are going to have more impact on certain names just because maybe they have a higher success rate or whatever with their calls. The other thing is, if you just look at whatever bank or whatever the firm is, usually the size of the firm is an indication of how much power they have behind them or whether or not they're a top tier firm. Top tier firms are going to be the biggest. Lower tier firms are going to be smaller.
And so when you're talking about bigger firms, are you referring, like, what do you use to measure that? Their assets under
You
management?
can measure it by market cap if you wanted to.
Okay.
Not all of them obviously are publicly traded, but that's the easiest way you could go about it.
Yeah. Okay. That's a really good tip. So let me run through some more questions here. So we had a question: when you buy options, do you just buy a call or a put? When IV is high, do you buy a spread instead? So are you just in calls and puts? Do you use spreads? Do you use any more complex option strategies?
Yeah, so I do use spreads. It depends. Like when I play Tesla, a lot of the times I'll use a spread. I'll use usually a butterfly spread or a vertical call spread. A lot of the times what I'll try to do if Tesla has momentum on it, and I did this on Monday, I believe it was. Oops, let's go to the Tesla chart here. I'm going to throw this up on the daily. This can go to 10-minute. What do we know about Tesla? It's a very expensive stock. There's usually a lot of premium on it, especially in the beginning of the week. What I'll do is if I see that Tesla has a bunch of room to the upside, I'm going to try to grab some just open-ended calls on it. As it pushes up, I'm going to sell some higher strike calls against it. So what I'll try to do if I can is turn Tesla into a vertical spread, but also at a credit. So if I can, for instance, buy some 680 calls at $10 and they go up to, $18 and it starts to pull back, and the $700 calls are now at $11. If I can sell those against my 680s and have a $1 credit on them, then that's fantastic. That's what I would aim to try to hold. So on expensive stocks, I'll do that at the beginning of the week. As the week goes on, Tesla, let's say I wanted to trade this into the end of the week, I'll probably look at doing something like a butterfly spread on it, where I'll try to figure out from a technical standpoint where it should be or where it could be between by the end of the week. And this just allows me to get into a position that's going to be a lot cheaper than just taking a call or a put on it. So yeah, absolutely use spreads. If you play high premium names or names that have higher betas, which is going to lead to a higher premium on the contracts, it's always a good idea to play spreads, especially if you're swing trading them. So for instance, if you do take a swing trade on Tesla and you wanted to go out a couple months, you can either go very far out of the money and have a low probability of those contracts working, which this year kind of proved that wrong. But you could also take a spread, a butterfly spread, vertical call spread, further out, which is going to make it a lot cheaper to hold. So yeah, absolutely use spreads.
Okay, and then a somewhat related question to what you were just saying there. Understood on setting stops for MAC loss for day trades, but for swing trades, how is risk controlled? And more specifically, the example that this person is giving is they're thinking about the time when there's an overnight gap, like downward, for example. So if you have a huge gap in the morning, what are you doing then during a swing trade to control your risk? It's a little bit easier to figure out when you're in the middle of a trade in a day trade, but for a swing trade, how do you deal with the gaps?
Okay, so are we talking about a swing trade that you're in based off of you want to hold it for a longer period of time, or are we talking about a swing trade that you decided that I want to turn this day trade into a swing trade because I think it could have continuation the next
longer
day?
Period from the beginning.
Okay, perfect. So when we look at a longer period from the beginning, we don't look at intraday charts. We look at only the daily charts or bigger time frames. Based on how long you're going to be holding a position should dictate which time frame you look at. So if I'm looking at a short to medium term time frame, like let's say a week to 2 weeks, maybe 3 weeks, I'm typically going to be using the daily chart. I'm going to be adjusting my size to where I think the stop area should be. So if I'm looking at, let's say, Tesla on this break of the downtrend here to the upside, I'm going to be trying to use, actually let's do this. Let's do a little bit further out. Let's say that I was taking it on this little range break to the upside at 509. Actually, let's go a little bit further out. Let's go up here. This allows it to be a little bit easier. So if I was taking Tesla at the 608 range break to the upside, and I wanted to, risk to below the stop area, which would be, right down here at 579, I would need to ensure that my risk reward had or was able to give me the amount of room I need to that trend line below it in order to meet my max loss amount and not get stopped out. So for instance, in this situation at 608 on the stock, I need to give it, what is it, to the stop? We're talking 30 points.
Bucks.
Yeah. So you would have to reduce your size in order to fit that. So on Tesla, and let's just quickly throw it at 608. In this case, size is gonna have to come way down. This is why it's a good idea to set this up on Excel for yourself, or just use a calculator. It's not super difficult to figure out. In this case, you would have to risk, or your full size would be 8 shares so that you can risk up to $30. Now, on the other side of that, if you're taking a swing trade, it's not just the risk that needs to be controlled. You need to ensure also that it has room to your profit target, which is 90 points above 608. So, you could easily have a target of $700 on Tesla when it did break this range to the upside. You just need to make sure that that actual profit target makes sense and is doable. And based off of that, you can adjust your size based off of your risk to fit. So when you look at swing trading versus day trading, swing trading, your size is always going to be lower. Yeah, and your stop's always going to be, below a trend or an EMA. You're going to try and use some sort of support level as your stop, or below that as your stop.
All right, awesome. Now, going back to when you were talking about analysts and how that actually affects things, we had a question here. Are you looking at upgrades or downgrades, or are you looking at price changes, or both?
I'm looking at upgrade downgrades based off of some sort of thing related to the business. When analysts upgrade or downgrade just based off of price, I don't think that brings a lot of merit into an actionable idea. The guy's just adjusting his price on the stock based off of the new price of the stock. He's just kind of, covering himself there. Whereas if he goes, okay, Amazon, for instance, we see that their growth in this certain, scenario or certain section market is going to be substantial. It should have a very positive impact on the earnings going forward. Our price target is now raised. Then I start to go, okay, that actually holds some merit. There's actually reasoning behind it. And obviously, if I agree with it, then that's even more of a positive. But that's what I would look at.
As a summary from what I just heard you say, if it's just a price target increase, that's not as big of a deal as an upgrade or downgrade, unless there's accompanying analyst color that gives you a reason for that.
Exactly.
Okay, and I'm really glad that you said that, Chris, because the way our news desk prioritizes some of these is exactly as you said. If a firm is just changing a price target, that's going to have less of a priority as, for example, an initiation or a new initiation, new coverage. Or if there's a price target change that has some more meat on the bone, if you will, our news desk is going to prioritize that over just a simple price change. So it's really great to hear you lay that out in a practical term in terms of how you actually trade. That's really awesome. We've got another question here from Wesley. Actually, I had the same question, Wesley, so this is going to be my favorite one. I appreciate the pragmatic and practical approach here. Can you share your risk-reward Excel sheet?
So one of the things, guys, if you want a risk-reward built for you, you can just shoot me an email and I can build you one. I don't send out the spreadsheet, but I do have a risk-reward calculator that I can give you that will basically do the same thing as a spreadsheet, except it's a lot easier to use while you're actually trading. And let me just show you an example of what that actually looks like. Okay. I give this to all the traders in the room. They can all download it, and you guys are welcome to have it as well. And let me just show you what it looks like. Where are you? There it is. Okay. So I'm just going to open it up real quick, and you guys can take a look at it. Where are you? There it is. So if you guys want this, and I can send it over to Ryan, and then he can.
Yeah, that would be great. And then you guys, what I'll try to do is I can include this in the automated email that goes to all of the registrants. And then if anyone has any trouble with that, feel free to reach out to me, and I would be happy to help you with that. I'd be happy to get that over to you.
So same concept, except this is a tool that you can use on the fly. And this is why I built this. I'm such an advocate on risk reward. If you guys are trading without risk reward, I say stop trading, flip the paper, figure it out first. What this tool does is, based off of the actual price of an equity or an option, we can really quickly figure out where the profit target needs to be, where your stops need to be on your full size and scale size. So let's say your risk reward is, again, my reward 750, I'm risking 250. The stock price is, we'll call it $40. My max size on that is going to be, I'm going to put $10,000 into the trade. Based off of that, we have your scale size, which is a quarter of your full size.
Can you zoom in a bit?
Yes, absolutely. Sorry, I'm on ultra wide screen. That's why.
No, yeah, it's okay.
Yeah, there we go. And let me just do this. There we go.
There you go.
So based off of that criteria, full size stop, if you had 250 shares, would be $1, and what you're looking for is $3 of room to the upside. Same thing on the options, except now we're just talking option pricing. Yep. So 50-cent contract, you put $500 into it. Your risk reward is $450 reward, risking $150 to make it. Then we have, again, full stops at $1, 15 cents below your average. You're trying to make 45 cents of room to the upside, and so on and so forth. So yeah, you guys are welcome to have this. I'll send it over to Ryan, and then he can send it over to you guys. Great little tool to use.
That is awesome. Now, one more thing here before we get out of here. Chris, I almost called you Spartan. I apologize.
No worries. Literally everyone does, even my the partners do and stuff like that.
So you are actually part of Benzinga Pro's affiliate program. And
yes.
I want to go ahead and post your affiliate link in the chat here. What's cool about the affiliate program is this is actually the only way to get a discount on the monthly subscription. At Benzinga here, we do occasionally offer sales like Black Friday, New Year's sale, all of that. But those don't apply to the monthly subscription. However, the affiliate promo codes do. And right now, normally they're 25% off. Right now, we're running a special where you can actually get 30% off. So that is Chris's affiliate link right on the screen there. I also posted it in the chat so you can copy and paste it if you need it. Please take advantage of that because, like I said, this is the only way to get discounts on the monthly subscription, and this is actually a 5% more than it normally is. So you definitely want to take advantage of that if you can.
Yeah, absolutely. And just a quick note, kind of on the same thing, but for us guys, just want to give you a little bit of a breakdown of what I do and what we do daily. So we're a mixture of day trading and swing trading. We have two different rooms that we alert ideas in. Day trading room, which is all streaming the entire day. We start at 8 a.m. We do an hour and a half of pre-market where we go through macros, commodities. We go through individual names. I break down the technicals on the individual names. We do an action plan for them. We go through the SPY, the FANG. We have our macro mod go through analyst calls for the day, going through bigger picture. Where he thinks the rotation is going to be on the open. We trade the open. We trade intraday options, equity all day. Swing side, options and equity, longer term trades. A couple months out if we're looking at expiration on options to years. We look at a lot of different leaps, especially on lower beta names. Text chat and streaming on the live. Text chat just on the swing. I do a lot of reinforcement. I do free calls with traders every single day. Again, a lot of this has to do with risk reward and accountability. So I like to see exactly what a trader is doing. I give them a lot of tools like journals and things like that to record what they're doing. So then I can pinpoint, okay, your risk reward needs to be worked on. The probability of success needs to be worked on. So we have to look at what setups you're taking that work and don't work. All that stuff is recorded from a data analytics standpoint using the journal. A lot of different things that we do, but we're a team of pros, technicals, options, macro experts. We got bio mods as well, things like that. So that's kind of who we are. And if you guys are interested in anything to do with us on a monthly standpoint, there's some promo codes as well. And you guys can give me a follow Spartan Trading on Twitter. I give out free ideas every single day on options equity. I guide the SPY all day. It helps a lot of people from what people have been telling me when I get messages and direct messages from them. So, if you guys want some guidance on that, happy to give it to you there. Anywho, that's it for today. Any final kind of closing thoughts, Ryan, or
No, well, yeah, I mean, I do have a thought here. So first of all, thank you so much for joining us. This is really important stuff. One of the things that's really special to me about this is that I talk to Benzinga Pro clients every single day. That's what my job is, and every single day I'm preaching risk and reward. I learned the hard way that risk and reward is going to keep you in this business and keep you profitable. So it's so great to see someone else that is a professional, part of a professional organization, saying the exact same thing. So I really hope that everyone took something away from this presentation that you can actually use. This is something that I've been preaching for a long time, and even I took things away from this presentation more than the spreadsheet that Chris agreed to agreed to send over. So I really appreciate you giving us your time, Chris. Thank you so much, and thank you so much for promoting Benzinga Pro. This is a project of love for us here. We're very into trying to create one of the best, most usable platforms for just the average person out there. So it's so great to see you helping us promote that. We really appreciate it.
Yeah, absolutely. And if you guys enjoyed it, we'll look at maybe doing some more different topics in the future. Okay.
Absolutely. I would love to have you back. I mean, we already touched on several things that we could expand on in the presentation. So thank you very much. Thank you everyone for joining us. I want to be respectful of your Friday evening. Everyone stay safe, and remember, until next time, happy trading.
Have a good one, guys.